Welcome back, friends. We are here again with Jason Hanson of OBX Mortgage. So our next topic is an important one that many clients ask. What is the difference, Jason, between a second home and an investment property?
Yeah, that's a great question. So, when you're looking to purchase a home on the Outer Banks, typically sometimes it is your primary residence, but most of our clients, it's going to be a second home or investment. And those loans are actually very similar, but they have some key differences. Number one, the main similarity, exact same interest rate. So whether you get a second home or investment loan, you're going to get the exact same rate. A second home loan is designed for those clients that are going to not rent out the home or maybe rent it out some but also stay in the property. An investment loan, you do not have to stay in the property at all. The minimum down payment difference, so second home you can put 10% down, investment property you have to put 15% down.
Okay.
Other than that, an investment loan can be very useful because we can use the future income of the property to qualify, whereas a second home we cannot. So we take rental projections for the property or a history of rents, and we use those numbers to boost the income of the borrower. So we always have to keep our debt to income of our clients under a certain threshold. If we're above that or riding that line, we can then do an investment loan where we're actually using that future income to qualify.
So that can be very helpful.
Definitely, yes, yeah. So it really, you want that property to cover itself, and we're just validating that for the lender.
Okay.
The only other piece I'll add is investment loans usually require around 6 months reserves. So this is money that you need to show you have in a bank account. You're not pulling this money out or giving it to the lender, just showing you have it in case the property doesn't rent and you have to cover the mortgage payment, whereas second homes do not require reserves.
Yeah, so reserves for you just means just the mortgage payment, not other expenses.
That's right, yeah. So it's 6 months of mortgage payment showing that you have it stashed in a bank account. Once closing occurs, you can do whatever you want with that money. The lender just wants to make sure you have it in the bank.
Okay. So another question is, I know when you are qualifying people, you do the PITI, principal, interest, taxes, and
Insurance.
Thank you. But do you add on for like rental properties, the management fees or any expenses like that, or is that just a wash?
That's a great question. So we are allowed to use the gross rents from a property. So we're not taking out any funds that would be used towards property management or utilities or maintenance or anything like that. So we take the gross number and that's what we'll use as far as qualification.